Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show. Welcome back, everyone, to the DIY Wealth Canada podcast. I'm Nelson, one of your hosts. I'm here along with Bob, and today we have our very first guest. I'm excited to welcome Mark Seed to the show. Mark, maybe you just start with a little introduction about you, where people can find you, etc.
Yeah, thanks, Nelson and Bob, for having me on. So yeah, I've been blogging for folks that don't know for about the better part of 16 years now. I am my own advisor, so myownadvisor.ca. The reason for the handle is hopefully fairly obvious in that I am my own DIY financial advisor. So I invest on my own, I do my own taxes, I do my own insurance, financial planning, all that kind of stuff on my own, and I've learned it on my own over time. The myownadvisor.ca site is a labor of love. Like I said, I've been doing it for many, many years now. It's fun to engage with other DIY investors, folks probably I wouldn't have met had I not had the site and the brand. And then I also run another site with my buddy, Joe, who founded Million Dollar Journey and who is also semi-retired. And that is cashflowsandportfolios.com. And that's all about financial planning, kind of beginning to end. And we offer free content, case studies, but also some low-cost projection services there if folks are inclined. So yeah, happy to be on the show, gents, and nice to connect again.
Yeah. Welcome, Mark. You and we know each other pretty well for a while now. Like we've been in the blogging for a while now, and you recently reached a really exciting milestone. You and your wife. Can you tell us a little bit about it?
Yeah, so happy to share that. So we've been working on our financial independence, kind of work on own terms. So I call it FIWOOT for short, simply because I never really believed in the whole retire early and never do anything again for income kind of lifestyle. But big fan of financial independence. So we've been working on that for the better part of 20 years together. And in the last, I would say, year, we reached financial independence and we've been working on the own terms part. So I've been part-time in my role at my organization since about April of this year. And I'm happy to keep working there till the end of our fiscal year, which runs around the end of March 2026. And my wife has been dabbling back and forth between kind of part-time work and full-time work, and potentially in the coming months, no work at all. So yeah, we've been on this kind of work on own terms tangent for the last few months, and it'll extend for the rest of the year. And it feels really good. Like working seems to be a little bit more fun, to be honest, when you don't have to do it for a living, but it is a nice transition, if you will, to full retirement potentially in 2026, or maybe some contract work with my organization, or maybe taking a sabbatical and coming back. I really don't know yet. I've got a bit of the summer to think that through with my wife and see where we want to go, but it's pretty cool to achieve the milestone, Bob and Nelson, and the site that I run and things that I chronicle on my site are all about how I did it and how other people can too.
Mark, fantastic kind of journey that you've had, especially lately, of course, going to part-time work. I'm sure a lot of the people listening would be interested in sort of doing something like that themselves, whether it's at this point, whether it's a little later, whatever. Can you talk a little bit more? And I know you can't go into specifics, but talk a little bit more about sort of that transition with your employer when you brought it up, and maybe a couple of tips on how to give to people who are looking to do the same thing. How would you recommend that they bring it up to their employer and to get the employer on board with it?
That's a lot to unpack, Nelson, but I'll do my best. So, I would say if people want a bit of a recipe to what I did, I would say the first step is start early. So, there are people in my organization who have followed my website. They subscribe to my newsletter. And, they gravitate maybe to some things I talk about in terms of, low cost investing and doing it yourself and not paying high fees in the process, et cetera. So, we've kind of talked with some few people, colleagues in my organization about some of those things over the years. But ultimately, when it came to my direct management team, I basically said, start early. And what I mean by that is, start the conversation early. So my conversation around work on own terms actually happened a couple years ago. I was hinting that in my late 40s, that I'd like to stay with the organization. I want to contribute to the organization. I certainly believe in the organization's mission and mandate and all the great things that we do. But at the same time, that's a big world out there. There's a big chunk of my personal time that I want to have back, if you will. So people talk about work-life balance. I like to flip that and say it's more about life-work balance. So I had those conversations with my management team, probably, like I said, about 2 years before I was really thinking about leaving. And then it was really step two was an ongoing negotiation in terms of how am I feeling about things, my commitment to stay with the organization, but obviously just do it at a lower capacity. So that would be step two, is just keep the dialogue open after starting that conversation early. And then I would say part three of this, which I don't mind sharing this, is, maybe know your worth a little bit. And that if you're a tenured employee like myself that's been there 20, 25 years, that's a lot of organizational history. That's a lot of relationship building that you've established. That's some chips in the bank, if you will, in terms of knowing how to work with different people in the organization, different divisions and teams, et cetera, vendors outside the organization. So know your worth a little bit. And then, use the start early, ongoing dialogue, and know your worth as part of your negotiation. It doesn't mean it will happen. It doesn't mean it's a slam dunk for your organization or your management team or your VP or whoever you're working with. But I would follow the start early, open, honest dialogue, and then know your worth. And, which I haven't done yet, which part four is be willing to step away and stay true to yourself. If you really want to retire early or do financial independence, work on own terms, it's okay to step away. It's okay to take a sabbatical. It's okay to take risks because you've kind of earned the right to do that with your financial means and investing. So that would be my long answer, if you will, Nelson, to a complicated question without getting the details. But I hope those kind of stepwise process will help people.
Great answer. Fantastic.
So, Mark, walk us through a little bit on your investment portfolio construction. And I know you're hybrid investor just like us, but walk through us about your thoughts on why you went with hybrid rather than just dividends. And we could go from there.
Yeah, so great question. And I do write about this quite a bit on my site. So I kind of thought around coming out of the great financial crisis, if you will, like that kind of 08, 09 kind of period where things were tanking quite a bit and financial calamity was ensuing. And I kind of looked at my portfolio at the time. I was just starting the early days of the blogging and such. And I was thinking to myself, I know as an investor, I value income. So dividends or distributions are quite appealing to me, but I also value growth. So kind of a lazy way of investing through low cost ETFs, whatever those ETFs may be for you. They could be like purely plain vanilla kind of index funds, broad market index funds that were more coming into vogue at the time. They could be even sector ETFs or maybe even dividend ETFs or the like. So I kind of sat back for a while and I thought, okay, what do I value? What do I gives me momentum and keeps me invested and keeps me honest, keeps me motivated about my plan. And I realized that the two parts of income and growth, because you can't have tons of each necessarily. They're kind of two sides of the same coin. I see it. So you can have higher yield and dividends and distributions, but you probably won't have a lot of growth. And then obviously if you have a tilt to growth, you're probably not going to get a lot of yield or income from your portfolio. But I kind of like the mix of the two. So I said, okay, well, how do I construct a portfolio like that? So I kind of looked at XIU, which is a long-standing iShares ETF as a proxy. That one that I think both of you well know, it's the top 60 companies in Canada. It's a low-cost product. If you don't want to do individual stocks, it's been a outstanding low-cost fund for the Canadian market for literally decades. And it may have been the first ETF in the world, to be honest, on that note. But in any event, I looked at XIU and I looked at the holdings and I said, well, do I buy XIU or do I own the top stocks or are there many of the companies in it? And I looked at the banks and I looked at the other financials and I looked at the insurance companies and I looked at the railroads and the grocery stores and the list goes on. And I thought maybe I can just own those companies outright and just, avoid the XIU fee because I gravitated to the income part of that coin that I talked about. So yeah, I started buying those stocks, to be honest. I started with Enbridge and I continue to hold this company to this day, 16 years later. And then, think about the growth side of the coin. It's like, okay, well, I can't probably own all the stocks in the Canadian index by myself. That would be expensive through fees and behavioral mistakes and so on. But I also thought, well, I need to get investing around a world of stocks. Like I got to look at the US market and I got to invest in international markets. And I thought, okay, maybe ETFs are the best way to do that, because then I can own literally hundreds, if not thousands of stocks for a low fee and just ride the returns of the index that they follow. So I've been in and out of a few ETFs over the years, but I've since gravitated on another iShares product, XAW. That's a X Canada. So it owns a world of stocks, just basically not Canada. And I own a few like a tech ETF as well as one of my main kind of equity ETFs. So that's kind of the portfolio construction today. It's about 25 to 30 stocks, mostly Canadian, a couple lingering US stocks, because I've since sold most of them off just to be really lazy with that X Canada ETF and the tech ETF. So yeah, that's the two sides of the coin that I have. I have the dividend income that's flowing in and rising every month, which is awesome for full retirement planning or funding and spending in 2026 maybe. And then I've got the growth story because I invest in low cost, lazy ETFs that hopefully deliver, long-term capital gains and appreciation through that route. So that's really the sum of the parts. It's an income story and it's a growth story for my portfolio.
Mark, do you envision at some point in the future, 2026, you're fully retired, you're, working less, and then you have more time in your hands. So do you envision a future where you might spend more time looking at individual stocks and go a little bit away from ETFs simply because you have the time on your hands that you can research them? Because I found that when I stepped away from full-time work a few years ago, that I did have the time to spend on these things. And I really found that I enjoyed it and that I enjoyed writing about it and everything like that. So is that something that you've thought about, or is it more of a kind of a long-term thing where you're moving a little bit away from kind of individual stocks and more towards ETFs?
Yeah, that's a great question. You know what? I'm actually not there yet. So my answer to that one, Nelson, is a bit of I don't know. I think if I had to predict the future, 2026, 2027, I'll probably get more interested in individual stocks. I'm not sure if I'll write them as much. Maybe I'll get into more details on the blog and I'll go into, a rabbit hole for some of the companies that I own and justify why I own them, or, look at any potential forecast myself for that. But I could equally also say that, once you've kind of fulfilled some of your goals and you've kind of passed some great benchmarks, it's time to look beyond that and, look at new things, if you will, right? So I could see where I continue obviously to run the website and I talk about my financial journey. And I think what would be really important for people who have followed me for many years is to start actually sharing, which I'll get into. And I've shared a little bit already on my site, is the whole drawdown, right? Like Nelson, you've been stepping away from your full-time job for years, right? So how do you actually live off the income, or how do you live off the portfolio that you've worked so hard to build? And Bob, you're probably on the cusp of that in the next few years yourself. So what's really interesting is you kind of look at it like for the geeks out there, maybe the normal distribution curve, right? You've been building and building and building, and you get to the middle of the curve in this graph, and you're kind of at the hump. You're at the top of the hill, if you will, and then you're like, okay, well now it's time to actually enjoy some of the money that I've worked so hard to build, and now I'm kind of coming down the other side of the hill, right, with the drawdowns and the spending and living my best life, if you will, for the things that I've tried to accumulate. So I could see both ways, Nelson, in your question, and that I could see myself writing a little bit more about some of the stocks I own or some of the stocks or ETFs I want to buy more of. But at the same time, I'm really comfortable with just having a core of the 25 to 30 companies that I own, and then the lazing and investing for basically everything else as an extra diversification hedge. It's simple. It's fairly tax efficient from that perspective, and it's meeting my income needs. So I feel like I've accomplished all those goals already, and it's more just about, sustaining that, preserving that, maybe writing about that, and worrying about the kind of the downside, if you will, in terms of drawing down the money that we've earned. If that makes sense, right? Like I said, I could see myself going down a rabbit hole, but will I really want to go there when things are working and I'm happy with the way things are? I don't know. Probably not either.
Yeah, I think you just kind of have to take a wait and see approach. There's so many variables, especially once you do retire and live off your investment portfolio. So we wanted to talk about withdrawal strategies, but before we get into that, Mark, can you tell us a little bit on how you're handling in terms of cash reserves? Because I think that's one of the biggest questions for a lot of investors looking at retirement is like how much cash reserve one should hold, call it rainy day fund if you want it. And, that kind of reflects into, I know you were dripping before, like when do you turn it off so you have some cash in your accounts, right? So tell us a little bit about that.
Yeah. So I think it's another really important concept that you bring up, Bob, in that, everyone's kind of cash position or kind of cash equivalence position, as I call it on my site and talk about. I think it's all different. Everybody has their own sleep at night factor, if you will, in terms of what they're comfortable in keeping on the side. I can break it down this way, I think, for folks, because it's probably more tangible for people to think about where the money is in certain accounts, if you will. But I would say from a high interest savings account perspective, we've always kept about, let's say, 10K. And I put that on my site. So it's not anything that I'm not sharing with anybody, but about 10K is an emergency fund. It's like a standing emergency fund where, things break around the condo or the house or the car or whatever it may be. We've got a little bit of money sitting there that we could be like, access super liquid and it's basically available for us. So we've kind of had that for well over a decade now. So that's kind of an easy sleep at night factor. But when you asked about drawdowns and drips and the order of the accounts a little bit, I think that you're inferring to. Beyond that, we have turned off all the drips in our since turned off all the drips in our taxable account, just because, more dividends and the like would just end up eating away at more tax. So I don't do that right now just because I'm still working part-time. So those drips in the taxable accounts have been turned off. But the thinking there with that one, Bob and Nelson, is I am going to be living off some of the dividends from those accounts, so those taxable accounts in the coming years. So it won't fund my entire lifestyle, but the dividends that flow in typically quarterly amongst, the 25 to 30 companies that we own, that cash flow will be coming in. The cash will get used for basically living expenses, and I won't really be touching the capital at all in any near term. TFSAs, I'm actually not touching at all. The drips are turned on for that one. I figure it's just a great way to even build a much more larger emergency fund. And with the dividends being reinvested, it's basically like the dividends were never paid in the first place, whether it's ETFs or stocks. So the money's just compounding away. And you both well know that we can talk about that a little bit more, but TFSAs are just a gem of an account, right? Like where else do you get that tax-free compounding power, because you've already paid taxes on the money to throw into it. So as an aside, for some of the work I do at cash flows and portfolios, like I've seen individuals and or couples have like hundreds of thousands of dollars now in their TFSAs, making 10, 15,000 a year in dividends and distributions. So it's pretty incredible right now. And that's only going to get higher and higher as long as they invest in the account. So drips are turned on in the TFSAs, but I won't be touching the TFSAs near term. I'm going to leave those accounts kind of alone for a while. And then when I think about my RSPs or the other registered accounts, drips are turned off. Again, cash is accumulating in there, and I'll be just basically withdrawing the cash for the other part of my living expenses. So we also have LIRAs, so locked in retirement accounts for folks that are familiar. Those will be turned into LIFs, life income funds, in probably another 3 or 4 years. And that'll be another income stream for us in our mid 50s once we get there. So yeah, I would say, long answer, but the mix of, turning off the drips and letting the cash flow, letting the cash kind of cushion, if you will, build up so that I can withdraw the cash and not really sell any of the stocks is a big part of our early retirement plan for the next couple of years. And it's my hope that while we've got the funds kind of largely ready to go for 2026 spending, with those dividends being turned off and some of those key accounts that I mentioned, the dividend reinvestment plans turned off, my thinking is that the cash will build up for 2027 spending pretty soon. So that's the thinking. And I don't know, Nelson, you're already retired. You may have a similar approach. You may be spending some of the dividends yourself or distributions, but it's a way to kind of, for me, just create meaningful cash flow in the next few years, and we'll adjust from there.
Makes a lot of sense. Yeah,
I am spending the majority of the dividends that come in. I spend from my margin, my taxable account first, because I have to pay the taxes on those anyway. So I just grab from those first because it's easiest. Like the tax situation has already been dealt with. I can't avoid that. And then from that, then of course I'm going to withdraw from my RSP after that, which, because my earned income is so low, yes, I have a newsletter, I make some money off that, but it's not very much. So that keeps my earned income quite low. So that also, those withdrawals are taxed relatively attractively. Mark, I was going to ask you, how much do you think taxes are going to play into your withdrawal strategy? Is it like, do you envision there being a situation where you'll look at your tax situation coming up and say, hey, I can afford to withdraw more from my, say, RSP this year and pay comparatively less taxes on that? Or is it just as the cash flow is needed?
Yeah, my thinking is I'll probably adjust. I think the first year I'll probably make some, I wouldn't say sizable RSP withdrawals from the cash that's already sitting there, ready to go for 2026. But, I'll probably make a little bit just to fund my lifestyle and, file my taxes and kind of adjust things in the the spring timeframe like everybody does and see. But I do anticipate, in years 2, 3, 4 down the line, I probably will take more money out of my RSP or my registered accounts sooner than later to get the money flowing for lifestyle, but also really just, and I've written about this on my site quite extensively, but just to really smooth out taxation, because I've seen the benefits of folks who have a healthy RSP or, lift balance where, if you get the money flowing from your registered accounts, especially for early retirees sooner than later, A, you can meet your income needs, and B, you can smooth out taxation over time. So you don't have these lumpy tax hits when maybe CPP comes online in your 60s or OAS at 65. If you have a workplace pension, which I also do, a small DB pension, defined benefit. Sorry for the acronyms, but defined benefit pension. So that'll be coming online for me at 65. So I have an opportunity here, I would say in my early 50s to 65 to start getting the money flowing a little bit before those other income streams come online or are forced to come online, especially for CPP and OAS by age 70. So that's kind of my thinking is A, to meet my income needs, Nelson and Bob, but also to smooth out taxation, because I just don't want a big lumpy tax hit or to be deferring a bunch of taxes into my early 70s. If, hopefully I have a healthy long life and turn RSPs into a RIF and those types of things later on in life. But I don't want to be forced to take tons of money out when I really don't need it or want it. So I would encourage any early retirees or even folks in their late 50s and 60s that are looking at financial planning and income projections and the like to really, obviously look at their income needs, but just the ability to smooth out taxation from registered accounts or non-registered if they have them, workplace pensions if they are lucky enough to have one, or LIRAs and LIFs and the whole alphabet soup that goes with all the accounts they may own. Because taxation is an issue, but also paying taxes, paying lots of taxes, if you will, if you can avoid it, is good. It's just smart financial planning strategy.
That raises a very good question, Mark. Are you planning to collapse you and your wife's RSPs before you have to convert to RIFs? Or do you plan to just hold a little bit of money in both RSPs and then convert to RIF later on? What's your thinking there?
Yeah. So given I'm just in my early 50s now and doing my own projections and math on this for quite a period of time now, my thinking is most of the registered, and what I mean by that is the RSPs, the future RIFs or the LIRAs turned into the LIFs, life income accounts. I would say a big portion of that is going to be withdrawn in my 50s and 60s and probably by my early 70s. I don't know if I'll be able to spend it all, if you will. Good problem to have is spend it all the registered money by my early 70s. Probably could, and we might, but the thinking is 50s and 60s would be slowly drawing those things for those two reasons I mentioned, income needs and to smooth out taxation. And then at the same time, leaving probably the non-registered accounts a little bit alone. We'll see. May start drawing those down or moving some of those non-registered into the TFSA every spring when the new contribution room opens up. But that's my thinking is I probably won't have, Bob, a lot of registered, the RSP RIFs, LIRAs and LIFs into my 70s. There could be some, but my plan would be to obviously just enjoy the money and spend it and live my life a little bit. So I'd be surprised if I get to my 80s and I've got lots of registered assets. I'd actually like to move the tax deferred stuff that I've mentioned, the non-registered or the registered stuff, into tax-free, which would be my priority, TFSA every year, or move it into the non-registered where it's a little bit more tax efficient. That's kind of my thinking.
Yeah, that's kind of what we're thinking too. For those listeners that are not aware, when you make withdrawals from RSP and RIFs, the withdrawal is taxed at your marginal tax rate. So it makes sense to try to spread it out, because what you don't want to do is take a huge amount of withdrawal 1 year and get hit by a very high marginal tax rate. So spreading out makes sense. And what we're talking about is really planning for the future, because by age 71, you have to convert RSP into RIF. And after that, every year there's a minimum withdrawal percentage that the government mandates. So you're kind of have your hands tied a little bit. And if you have a really big RSP amount, and obviously when you convert to RIF, that means the minimum withdrawal amount is going to be pretty big. And again, therefore, your marginal tax rate might be pretty high, right? So that's kind of what we're also thinking as well, Mark. Try to make some withdrawals from our RSPs early on, maybe in our 40s or 50s or 60s, and then try to reduce the amount or even collapse RSPs entirely so we don't have to deal with the RIF withdrawals later on. But again, we'll have to wait and see when we get there. But I think converting your RSP money and put that into either TFSA or non-registered or both, that's a very, very tax efficient strategy to utilize. Nelson, any thoughts on that?
I think you guys both nailed it in terms of that. Just a little bit of common sense and look at what your income situation is, and each year, sort of after early retirement or when you do retire, doesn't matter what age it is, and just just recognize that you will have to draw down your RSP eventually, and that if you retire early, it's better to draw it down early when you don't have a lot of other income versus maybe waiting until you're 65 and you're collecting CPP and OAS, and then you have to worry about that aspect of things. Mark, let me ask you kind of about this financial planning that you've done. Maybe just sort of from the angle of the people listening who might think this is complicated. I don't know if I can do this. Maybe my best option is to hire a planner and get them to sort of guide this through me. Maybe just like, how complicated is it? Or is it really just a lot of common sense?
Yeah, I think I don't want to answer it depends, but it does depend. I mean, if you have a couple pensions and non-registered accounts and TFSAs and RSPs, and maybe you've got a former workplace plan from another company, still have kids living at home, boomerang children, whatever, to kind of get out of the house at some point, that can be complicated. And I think, when I think about how much is your time worth, or where does your time value money equation go, hiring a fee-only planner or working with myself and my partner Joe, or using some DIY tools that are out there and becoming more common, those are all good avenues, I think, to pursue. But at the same time, I would consider folks who have some passion for personal finance and investing, and who are fairly fluent in the differences between a taxable account or a registered account, and they can get through the alphabet soup and the difference between a tax-free savings account and a LIRA and some of the concepts we talked about. If they're fairly savvy enough and have some financial literacy on things, I don't think it's overly complicated, because when you think about the pool of assets that you have, consider it all one big portfolio. And then, when I looked at my kind of steps in terms of, writing up your own financial retirement income playbook, which I actually have a post about that, I think it boils down to a couple of key steps. One is think about all your assets as one portfolio, and just think about the timing of those assets. When do you need certain amount of money, and where would that money come from? So, if you're 65, well, then maybe you can turn on CPP and OAS at the same time, right? And if you have a workplace pension, that's your base. That's pretty straightforward. But if you're retiring earlier than that, like I said, you may have multiple other accounts to consider, but you need to figure out, first of all, what you intend to spend, and then the timing of when that spending may occur. And that's like a fairly simple 2-step process that I think most folks can wrap their heads around. So on one hand, I would say, it can be challenging because people may have a lot of things going on in their lives. They may have not paid too much attention to things. They've got busy lives. They've got multiple accounts and so on and so forth. So you may want some help. And I think, there's definitely more and more avenues for services to help you out with that, either from a DIY or from a fee-based perspective. On the other hand, you can do it yourself. There are tools out there. There are calculators out there. There are free stuff, and you can basically take a mix of those tools and stuff and really do this yourself fairly easily. So I think it really depends on your literacy and how much time and passion you want to put in these things. But it can be complicated for some, and in other people you can do it on your own. And I'm happy to say and see there are a wealth of free calculators, tools, different services coming online to really close the gap between, I would say, some very expensive services that have historically existed and some of the lower cost alternatives that can do a really bang up job as well.
Yeah, I think everybody's situation is a little bit different, right? But there are so many different tools, like you mentioned, Mark, available on the internet, and there are cheaper services available as well. And I think hiring a fees-only advisor or even tax specialist could help, especially if your tax situation is very complicated. But yeah, you can just hire somebody to give you some consultation for an hour, just to get some idea, make sure your thinking is correct, right? So there are so many different ways to do things, and just like personal finance, there's no really one way to do things. It's very personal, and that's something I want, and I'm sure Nelson agrees as well. We want to emphasize that personal finance is personal, same as investing, right? So, we do invest in both dividend and index ETF, just like you, Mark, or Nelson invest in dividends, and some other people may invest in real estate or other appreciating assets. So it's all personalized. It all comes down to personal preference. As long as you're growing your net worth, your assets, that's the important part. Tell us a little bit, now you're working part-time and you're looking at, eventually exit full-time employment. Do you have any travel plans or any big plans in the making for you and your wife?
Yeah, I mean, we have a few near-term plans. We have an aging cat, to be honest, that we care for, and we don't want to leave him alone too much. So that's kind of hampering a little bit of our travel plans in the next little bit. But we have plans to go out west, actually, to Victoria. So we'll be flying, I think, over your city at some point, Bob, in the coming months and stuff. So sorry, we're not able to stop by, but I can wave down below. But yeah, we've been to Vancouver many times, but we've never made it to the island. So our thinking is to spend a week or so there. We may try to take a trip to the south again. We were fortunate to go to Belize last winter, and I think Costa Rica the year before for a week or so, or 2 weeks rather. So we may try to go down and do a southern destination again in the winter, but we'll see. And then longer term, we're actually looking at some transatlantic cruises. So we haven't picked one yet, but we're starting to look at, a 2-week kind of cruise, or potentially even a bigger trip, looking at Australia and New Zealand in a couple of years. So that would be probably a multi-week trip. And it may not be on a boat necessarily, but just plane and land touring and that kind of stuff. So all those things need a bit of money, but also they need a bit of time. And I think the time is working out well, where we're kind of, financially dependent, work on own terms. And then, the money is hopefully there with what we've saved and being debt free. So that feels pretty good. So yeah, I'd like to say it's starting to come together, but some plans in the near term, and then like a bunch of things that we want to do, I would say, in the next couple of years that border on, multi-week or multi-month kind of destinations. So that would be a lot of fun.
That's awesome. Too bad you were not making to Vancouver. It would be great to catch up. But if you're in Vancouver Island, if you have a car, like the Malahat Skywalk it's pretty cool to check out. So definitely take a look there.
My wife is very good at researching our trips, and it's a shared responsibility, but that's part of the thrill she gets, is kind of planning some of our trips. And it's actually on the Skywalk is actually on our to-do list when we go out there, Bob. So I appreciate you mentioning or validating that, because that looks really cool, and it's something we're looking forward to doing when we're there.
Awesome.
Okay, let me ask the question that I think is on a lot of people's minds, which is, how do you know that you have enough? How do you know that financial independence and FIWOOT is actually going to work for you? And as sort of a addition to that, was it a dollar amount that you were very specifically looking at, or was it a factor of your spending? So was it a certain number with 6 zeros after it, or did you really look at, okay, this is what we spend, and from there, then you sort of built your kind of retirement budget backwards? Maybe talk to us a little bit about that, if you could.
Yeah. So I think it all starts on kind of your end game in mind, Nelson, in terms of what you want to spend, right? So I know folks that are more than happy to spend, let's say, $4,000 a month, or they're spending $5,000 a month, give or take, right? So that's $60,000 a year after tax, and that works for them, and that's perfect. And folks can follow me for free, as they know, on moneradvisor.ca, and I posted our financial independence update. I've posted our own financial independence budget. But when it comes to that playbook I alluded to, that kind of free retirement income planning playbook, I think it always starts with kind of the end game in mind, which is, what are your spending goals? So some Canadians, I've said in the post, can live off a little, and that's all they want to do. They want to have a modest retirement, a little bit of travel, a little bit of fun, a little bit of volunteer work, etc. And that's awesome. That's their lifestyle. Again, personal finance, personal kind of mantra. Other Canadians want to live off a lot, right? Maybe they've deferred travel because they've been busy raising kids, or they've got a cottage, or other kind of little luxuries in life, right? So the headlines come out every couple of years or every year, right? This study says you need this much to retire. This study needs that much to retire. The number changes every year, right, Nelson and Bob, depending on what study you want to read from what institution, et cetera, et cetera. And ultimately, I think what you want to figure out is your own spending goals. So my spending goals may be different than Nelson's, which could be different than Bob's, and that's not right or wrong. It just is what it is. Those are just the facts. So once you figure out your spending goals, then you can kind of start figuring out, okay, how much zeros, to use your words, Nelson, how many zeros do you need to feed the spending goals? And so in my playbook that I wrote about, now that you've got step one figured out, which is what are your spending goals, now what are the income sources that you need to feed those goals? So when I looked at our own plan, and let's say for sake of argument, I said, hey, I'm going to take my OAS at 65, and I'll probably take CPP at 65 or later. And Bob, you hit on this earlier with me, maybe starting the RSP/RIF withdrawals in my 50s and 60s. Am I going to be able to spend X for us, right? I'm going to meet those spending goals by doing all those things, right? Deferring the CPP, taking OAS at 65. Where's the money going to come from in the meantime? And so what I basically did is, did my own retirement income projections with my wife. And I said, yeah, we can make this work, knowing those income sources are going to come online later at certain times to feed our lifestyle. And maybe for interest, Nelson, I mean, you've been retired, I think, for a year or so. And Bob, like I said, you're on the cusp of it a little bit. But our range is probably in the $6,000 a month, right? Spending after tax. So that's kind of where we're trending. We have buffer built in where we could spend a little bit more. And we also have, spending that could be a little less. I don't really know, but we've been tracking our spending needs for about 2.5 years pretty diligently. And that's kind of in the wheelhouse of what we think we want to spend, including some travel. So with buffer built in to spend more, we could always spend less. That's easy. But do we want to spend more, or could we spend more? Yes. And so we've got that buffer built in. So to recap, I think it always depends on what you want to spend and when you want to spend it. And then you need to figure out your income resources in retirement to make sure that those needs come online when you want it. And that's essentially a fairly simple but effective 2-step process that we went through for retirement income planning. And it may be interesting. We know we didn't hit on this, but it's in the weeds. But what rate of returns would I need, or what inflation factors would I need? That's probably, we could probably spend on that for the next 40 some years at probably 3% inflation, maybe even higher if we needed to. And the rate of returns we would need are probably in the range of about 5%, give or take. So when I put all that into the hopper and I looked at our portfolio and what we own and the income story and the growth story, if we can get 5% returns coupled with 3% higher inflation over time, if that's what inflation runs at, that's like 2% real return for folks out there keeping math. We should be okay.
That's fantastic. So, Mark, we're coming up to the end of the podcast. So I have one last question. It's kind of related to withdrawals. Are you and your wife planning to withdraw kind of one time each year, or are you going to spread your withdrawals throughout the year? What's your strategy there? Because I think that kind of plays into how the market is doing and so on, right? So walk us through your thoughts.
Yeah. So my thinking on this, and I would be curious to get your take on this, but I'm sure both of you have watched or read many studies over the years about lump sum investing versus DCA, right? So you can put in money in the market at once or you could put in money, that same amount of money in kind of predictable fashion over time, right? So kind of dollar cost average in as you build your portfolio, like asset accumulation years. I see, using that analogy of normal distribution, that curve, it's actually the same for asset decumulation. You can take out money in a lump sum at the beginning or the end of the year, or you can dollar cost average, but in reverse, right? So what I'm thinking is, because lump sum investing tends to work maybe 65 to 70% of your time, right? And that's because the sooner you get your money working, the better, because generally markets go up. Otherwise, people would invest in them. So, if markets tend to go up 60 or 70% of the time and you're doing lump sum investing, then you can kind of do the same in reverse in retirement withdrawal years. So I would tend to lean on taking a one-time kind of lump sum out at the beginning or the end of the year. And that discretion is up to you in terms of when you want the money and when you pay taxes or feeding your TFSA and other things that may come into play. But generally speaking, take a lump sum out from the registered accounts, Bob, at the RSPs and the LIRAs, and the RSPs in particular. The lifts will be different because there'll be more DCA in reverse, whether they're monthly or otherwise. But taking a lump sum out and then allowing the rest of the tax deferred money to grow, and then just rinse and repeating every year for the next few years. And the same may apply for RIF withdrawals, as well as taking a lump sum out and letting the rest of the money sit there for tax deferred growth, if you will. So that's the thinking right now. I could always change my mind, but I would encourage people to think about kind of what got you to your wealth destination or your asset accumulation goals. It's just changing it in reverse. And you can do lump sum investing in your asset accumulation years, and you can do lump sum withdrawals in your asset decumulation years. So consider kind of that approach, and that may or may not work for you. And that's where DCA in reverse comes into play, in that some people sleep at night. We talked about that earlier. Some people have a sleep at night factor. They don't want to do lump sum investing in their asset accumulation years. So they do dollar cost averaging, which is totally reasonable and totally acceptable. And you can also do, quarterly or monthly RSP or withdrawals in your asset decumulation year. So it's really up to you, but I'm actually a favor of the lump sum reasons for the concepts I mentioned.
Mark, that's fantastic. We could keep going for, I feel like, hours, but we got to wrap this up. So thanks for coming on. We appreciate it. And I think people listening appreciate it too, because there's a lot of knowledge you just dropped on us in about 45 minutes. So once again, can you let everyone know where they can find you if they want to have more Mark in their lives?
Yeah, they can find Mark for free at myownadvisor.ca. It's, like I say, my labor of love that I've been running the personal finance and investing website for the better part of 16 years now. It's hard to believe, but it's fun to run. So a quick Google search or whatever your search engine of the day, My Own Advisor, and it should come up pretty high on your list. So I spend a lot of my time there. And then the other passion that I have is really helping all DIY investors in terms of their drawdown, their income story, and we do that in a low cost way. There's a DIY kind of service at cashflowsandportfolios.com. So that's the tool that we leverage, and we basically allow people to become their own financial planner and their own fee-based planner, but they don't pay a lot of fees for it. So that's one path. And then there's also some done for you reports as well that we offer hefty discounts just for being a My Own Advisor follower, because I would expect that as a DIY investor myself. So might as well give people discounts. So yeah, that's where I spend my time, and then still working part-time with my employer, and happy to do that till the end of March. And we'll see what 2026 brings. But I hope you have me back sooner than that, gents. And it's always a pleasure to talk investing and saving, and just encourage other people to save and invest where they can, as much as they can, and help them realize their own financial independence goals, wherever they may be.
Yeah, thanks, Mark, for coming on today. And we'll definitely have to get you back for a future episode or even future episodes. Thanks again.
Awesome. Thanks, guys.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.